Usually when we talk about a diagnostic test, there's this underlying expectation of precision.
Right, like a binary outcome.
Yeah, exactly. You break your arm, the x-ray shows a highly defined, jagged white line across the radius, and the doctor just points and says, well, there it is.
Broken or not broken.
Right. It's clean.
Right.
We inherently like things to be visible and, strictly categorized. But the moment you step into the world of corporate finance, and specifically the business of global risk management, that x-ray machine is fundamentally broken.
Oh, completely broken.
We are looking at a diagnostic landscape of the global economy that is, frankly, entirely opaque.
It's the absolute definition of diagnostic muddy waters. I mean, the risks that massive multinational corporations face today aren't just a fire in a distribution center or a slipped disc on the assembly line.
Right, the obvious stuff.
Yeah, the risks today are invisible, they're systemic, they are interconnected in ways that, frankly, most management teams can't even fathom until something goes catastrophically wrong and the liability cascade starts.
Which brings us directly to the mandate for today's deep dive. We are taking a magnifying glass to the Q4 and full year 2025 earnings call of WTW Willis Towers Watson.
And we aren't just going to skim the press release here.
No, definitely not. Operating from a data-forward, fundamentally opinionated perspective, we are stripping away the corporate spin, the sanitized buzzwords, and all those managed expectations.
Because that's what retail investors actually need.
Exactly. We want to figure out the exact mechanisms driving these numbers and what they mean for you, the listener, if you're holding or evaluating this equity. Because if you just read the headlines, you might think, okay, an insurance broker and HR consultant. Stable, highly predictable, maybe a little dry.
Yeah, dry is usually the first word that comes to mind for the uninitiated.
But if you listen closely to the structural economic shifts CEO Carl Hess and CFO Andrew Krasner are outlining, WTW isn't just a consultancy, it's a terrifyingly accurate mirror reflecting the absolute chaos of the global economy.
That's a great way to put it.
Think about the macro trends keeping global CEOs awake right now. We are staring down soaring structural healthcare inflation.
Which is brutal right now.
Right. We are watching the frantic, capital-intensive construction of AI data centers that, literally require the power grid of a small sovereign nation.
Oh, the power demands are staggering.
And we are seeing highly complex, punitive regulatory frameworks coming out of the European Union. Chaos is swirling around every corporate boardroom. And how does WTW respond to that chaos?
They monetize it?
Exactly. They leverage that global anxiety into $1.5 billion in free cash flow.
Which, when you look at the volatility of the macro environment over the last 24 months, is just an extraordinary metric to pull out of the market.
It really is.
And it requires us to set an analytical baseline right now. We need to look at the absolute hard data from the quarter, then tear down the mechanics of their two main business segments, risk and broking, and health, wealth, and career.
Right, the core engines.
Exactly. Then we have to scrutinize management's capital allocation playbook for 2026 to arrive at a definitive, actionable verdict, bullish or bearish.
Okay, let's unpack this and get straight into the hard data because Q4 2025 gave us a very specific profitability profile. Organic growth came in at 6% for the fourth quarter.
Solid.
Yeah, and for the full year, they hit 5% organic, which management confidently noted was exactly in line with their mid-single-digit target.
And, consistency is great, but the margins are really what stand out here.
Totally. Adjusted EPS came in at $8.12 for Q4 and $17.08 for the full year. Adjusted operating margin hit 36.9% in Q4, which is an 80 basis point expansion year over year.
That's huge.
And then the ultimate arbiter of corporate health, free cash flow. A massive $1.5 billion for the trailing 12 months, representing a 15.9% free cash flow margin, up significantly from 12.8% the prior year.
The margin expansion is the critical narrative here. I mean, it's the engine of the entire thesis.
Exactly. When I look at WTW's financials, I think about a massive distributed cloud computing cluster.
Okay, I like this analogy.
Right. So normally, to process a heavier compute load, which in this case represents top-line revenue growth, you have to spin up more servers.
Or infrastructure.
You incur more latency, higher cooling costs, higher power consumption. The efficiency of the system inherently drops as it scales. But WTW has somehow figured out how to optimize the algorithmic system itself.
Right, they're doing more with less.
Exactly. They are processing a significantly larger volume of data blocks, but their power consumption per block is actually dropping. They are growing the top line while simultaneously expanding the profitability of that exact same top line.
It's pure operating leverage. But to really see how hot that engine is running, you have to scrub the baseline of past corporate actions. I mean, the headline numbers are actually masking the true velocity of their earnings growth, specifically because of the Transact divestiture.
Right, the noise in the year-over-year comparison, I was looking at that. In the fourth quarter of 2024, the Transact business unit contributed 80 cents to their adjusted EPS.
Right.
But they sold it off. So going into Q4 2025, that 80 cents is entirely gone from the denominator.
What's fascinating here is if you run algorithmic screeners or just glance at the raw EPS print, the growth looks, well, adequate but not spectacular.
Right, because of that missing 80 cents.
Precisely. But Carl Hess was very deliberate in pointing out that if you strip out that 80-cent contribution from the prior year's baseline, Q4 2025 adjusted EPS actually jumped 13% year over year.
Wow. 13% adjusted EPS growth in a mature global brokerage business is massive.
It proves the cloud computing analogy. Yeah. The core operations, the retained businesses, are generating substantially more profit per dollar of revenue than they were 12 months ago. And Andrew Krasner noted that for the full year, adjusted operating margin expanded by 130 basis points to 25.2%. Even excluding the Transact impact, it was an 80 basis point improvement. That is what drove the free cash flow from 12.8% to 15.9%. They have fundamentally altered the cost structure of their revenue generation.
Oh, operating leverage isn't an accounting trick. It doesn't just materialize because a CFO wills it into existence.
No, absolutely not.
It's driven by the actual services being sold and the specific markets they are penetrating. So to understand how they engineered a 13% EPS jump, we have to tear down their first major revenue engine, risk and broking.
This is where the macro narrative hits the physical world.
Yeah, and the data here is incredibly consistent. The risk and broking segment grew 7% in Q4. Zooming in, the corporate risk and broking division CRB grew 8%.
I have to pause on that 8% for a second. In corporate finance, stringing together 3 or 4 good quarters is commendable. Management noted that Q4 marks the 12th consecutive quarter that the CRB business has recorded high single-digit growth.
Wait, 12 quarters?
Yeah, that is 3 full years of high single-digit organic growth in corporate risk through one of the most volatile interest rate and macroeconomic environments in modern history.
That's incredible, and North America was a massive driver of that. CRB North America specifically saw high single-digit growth, and Lucy Clark, the president of Risk and Broking, credited their specialization strategy.
Right.
Now, obviously, every brokerage claims to be highly specialized. It's standard marketing collateral, but WTW is actually backing it up by aggressively targeting the most esoteric, highly complex specialty lines, construction, surety, marine, natural resources, and M&A transactional risk.
They aren't competing for the standardized liability policy of a mid-sized logistics company. They are embedding themselves in bespoke risks.
Yeah, the complicated stuff.
When a multinational wants to execute a multi-billion-dollar merger or construct a massive physical asset, the risk profile requires deep knowledge of overlapping regulatory regimes, volatile global supply chains, and environmental liabilities. WTW has invested heavily in the underwriting talent for these specific high-margin verticals.
Which leads directly to the most fascinating data point from this entire segment. WTW insures 5 of the 10 largest data center developers globally.
Half the market.
Yeah, and Carl Hess announced they just won a highly competitive master builder's risk placement for one of those top 5 developers.
It is a staggering market share and arguably the most critical real estate asset class of this decade.
I do have to push back on the moat here, though.
Okay, let's hear it.
Wait, isn't insuring a data center just like insuring a really big warehouse with some computers inside? Why does that require a specialization strategy? Why can't a competitor just look at the replacement cost of the building, the value of the server racks, apply a standard catastrophe model, and underwrite the premium? Why does WTW dominate this specific niche?
Well, because treating a data center like a static warehouse full of expensive calculators is exactly how an insurer gets obliterated.
Obliterated? Really?
Oh, yeah. A data center is a dynamic, highly volatile, interconnected systemic entity. The physical construction alone is a nightmare. You are dealing with specialized cooling systems where the supply chain is backed up for 18 months.
Wow, 18 months just for cooling parts?
Yes. If an HVAC unit fails during a stress test, You don't just have water damage. You have a thermal event that could literally melt down hundreds of millions of dollars of GPU clusters.
So the builder's risk is exponentially higher than a standard commercial build.
Exponentially. But, the physical asset is just the first layer. The operational and systemic risks are where WTW actually earns its fee. We're talking about severe cyber aggregation risk.
Because all the data is concentrated.
Exactly. These facilities host the intellectual property, the operational data, and the live applications for Fortune 500 companies. A localized breach or a ransomware event that affects the cooling system software isn't just a property claim.
Yeah.
It triggers massive contingent business interruption claims from every single tenant in that facility.
So you're triggering a cascade of complex service-level agreement breaches across multiple global entities.
Exactly. And then layer on the environmental impact liabilities regarding localized water table usage for those cooling systems and the strain on the local power grid. It's a massive web of interconnected, multidisciplinary liability.
So it's not a simple property policy.
Not at all. The developer's question isn't who can insure the building. It's who can orchestrate a risk transfer mechanism that covers cyber, environmental, heavy construction, and third-party SLA liability simultaneously.
Right.
WTW has built a holistic framework that covers the life cycle from the initial project financing through the builder's risk placement all the way into steady-state operations.
You can't syndicate that out to 5 different specialized brokers who don't even talk to each other. You need a centralized architect for the risk. And that makes total sense why Hess noted the client chose them for the breadth of their global capabilities. As long as the AI supercycle continues, the capital expenditures flowing into specialized infrastructure will remain elevated, and WTW is sitting right at the toll booth.
And it extends beyond just data centers. The global energy transition is another massive capital sink requiring bespoke risk management.
Right, they talked about that too.
Yeah, Lucy Clark highlighted a complex electrification project coordinated across Australia, Spain, and London. Securing comprehensive coverage across 3 different regulatory environments under really demanding market conditions is exactly the kind of friction WTW monetizes.
They also highlighted their selection as the commercial broker for 2 major U.S. bank headquarter renovation projects, collectively valued well over $1 billion.
Massive projects.
Again, highly sensitive, high-stakes environments where generic commercial policies are essentially useless. But I want to pivot from the physical infrastructure to the technological infrastructure WTW is building internally.
Sure, let's look at the tech.
On January 27th, they closed the acquisition of Newfront. Management claimed this brings a modern, technology-enabled approach to middle-market broking.
It is a critical acquisition for the continuation of their margin expansion story.
See, I'm a little skeptical of the buzzwords, though. Technology-enabled approach usually just means they bought a slightly better CRM.
Fair point.
Right. Every brokerage claims to be integrating AI. What did Spike Lipkin actually build at Newfront that WTW couldn't just engineer in-house? And how does it actually change the unit economics of a middle market broker?
Well, the difference lies in the ingestion and workflow automation of highly unstructured data.
Okay, unpack that.
The traditional brokerage model, especially in the middle market, involves highly paid producers spending an inordinate amount of time on administrative triage. They're reading complex policy documents, manually extracting data points, cross-referencing coverages, and keying that data into legacy coding engines.
So it's essentially highly paid talent doing data entry.
Precisely. What Newfront built is a proprietary AI-driven platform that attacks that specific bottleneck. It autonomously ingests the unstructured data from client communications and carrier documents, structures it, and automates the routing and quoting workflows.
That's a huge time saver.
The dual benefit here is profound. First, it drastically increases front office productivity.
Yeah.
Brokers focus almost exclusively on client advisory and relationship expansion rather than paperwork. Second, it generates massive operating leverage.
Because you can push a higher volume of premium through the same or even a reduced headcount.
Exactly. They are taking this specialized platform and integrating it end-to-end to squeeze maximum profit out of the middle market, which has traditionally been a highly fragmented, really inefficient space.
And establishing a dedicated integration management office under Newfront's CEO shows they understand the cultural and technological friction that usually destroys value in these types of acquisitions.
Yes, that was a very smart move.
They are highly focused on generating tangible synergies over the next 36 months. So, Risk and Broking is out there mitigating external physical and cyber threats for the global economy. But WTW's other major revenue engine targets a completely different vector of corporate anxiety.
Right, the internal side.
We're talking about the health, wealth, and career segment, HWC. If R&B protects the perimeter, HWC protects the company from its own internal human capital liabilities.
And honestly, the internal liabilities are arguably more volatile right now.
Yeah, let's look at the numbers. HWC grew 6% overall in Q4. Breaking down the subsegments reveals a massive disparity in performance, though. Career grew an explosive 10%. Wealth grew 5%. Health grew 4%, though management clarified it was 6% adjusting for specific book of business and interest income headwinds.
Right, the adjusted number is what matters there.
And benefits delivery and outsourcing, BD&O, grew 5%. Let's attack the health segment first, because it perfectly illustrates our initial thesis of WTW monetizing global chaos. Here's where it gets really interesting. Management projected on the call that global healthcare inflation will exceed 10% in 2026.
A 10% structural increase in one of the largest corporate expense lines is an absolute nightmare for any CFO trying to protect operating margins.
And Julie Gebauer, the president of HWC, explicitly laid out the drivers. This isn't just standard CPI inflation. We are talking about the rapid proliferation of highly expensive medical technology, advanced gene therapies that cost millions per patient, and the massive utilization spike in GLP-1 weight loss drugs.
Well, those GLP-1s are incredibly expensive.
Right. Combine that with a post-pandemic catch-up in deferred preventative care, and the system is just bursting at the seams.
For a global enterprise, absorbing a 10% compounding annual increase in healthcare costs will destroy EPS.
But for WTW, this exact dynamic is a massive multi-year tailwind. I want to drill down into the mechanics of this paradox. Why does corporate pain translate so cleanly into WTW's top line?
Well, you have to understand the capital structure of corporate healthcare. The vast majority of Fortune 500 companies do not buy fully insured health plans.
Right, they're self-funded.
Exactly. They act as their own insurance company, bearing the direct financial risk of their employees' medical claims, and they simply pay a third-party administrator to process the paperwork. When claims inflation spikes 10%, that capital comes directly out of the corporation's free cash flow.
They can't just pass a 10% hike onto the employees every year without causing massive attrition or facing a union revolt.
Exactly. They are trapped between protecting their margins and retaining their workforce. So they bring in WTW's health consultants to structurally optimize the plan design. It's not just about negotiating lower administrative fees. It's about fundamentally altering how care is consumed.
Gebauer highlighted their RX Direct Access offering on the call as a prime example of this.
RX Direct is a perfect illustration. Pharmacy benefit managers, or PBMs, have notoriously opaque pricing models, often relying on spread pricing and rebate retention that drives up the ultimate cost to the self-funded employer.
It's a black box.
Complete black box. RX Direct bypasses much of that friction, optimizing the pharmacy supply chain to significantly reduce prescription drug costs without degrading the actual benefit to the employee.
How do they do that?
WTW's consultants analyze the claims data, restructure the pharmacy contracts, implement targeted utilization management for those really expensive GLP-1s, and deploy clinical intervention programs.
So they are essentially acting as the outsourced risk management arm for the employer's internal health plan.
And because the underlying drivers of this inflation-like aging demographics and expensive pharmaceutical innovation are deeply structural, the demand for this consulting is highly inelastic.
Employers have to buy it.
They have no choice. That's why WTW is projecting high single-digit growth in health for 2026. Steeper the inflation curve, the more indispensable the consultant becomes.
It's an incredible defensive moat. Now, let's look at the career segment, which posted that massive 10% growth rate. Hitting double digits in HR and compensation consulting implies a massive catalyst. And again, it comes back to regulatory chaos, specifically the European Union's Pay Transparency Directive.
The EU directive is a generational shift in how multinational corporations must handle human capital data.
Yeah, if you are a multinational, the words EU directive are synonymous with an immediate, massive compliance expenditure. Break down the actual mechanics of this directive, because it's not just a basic reporting requirement.
No, it is a radical overhaul of compensation architecture.
Yeah.
The directive mandates that companies operating within the EU must publicly report their gender pay gaps.
Which is complicated enough.
But more critically, it gives employees the right to request information on individual and average pay levels, broken down by sex, for categories of workers doing the same work or work of equal value. Furthermore, it shifts the burden of proof onto the employer in pay discrimination cases and mandates retroactive compensation if a gap exceeds 5% and cannot be justified by objective criteria.
So if you are a global bank with 20,000 employees spread across Paris, Frankfurt, and Dublin, you can't just have vague, overlapping salary bands anymore.
Not a chance.
You have to mathematically prove your pay equity or face massive litigation and retroactive wage adjustments.
And you cannot solve that problem with internal HR staff and a spreadsheet. The data orchestration problem is immense. You have to map highly disparate job titles across different geographies, adjust for local market rates, and calculate total compensation, which includes base, bonus, equity, and the actuarial value of localized benefits.
Which explains exactly why Carl Hess specifically highlighted a leading financial services firm that hired WTW to prepare their entire EU footprint for this directive.
WTW possesses the proprietary global benchmarking data, the standardized career framework architecture, and the sophisticated pay equity analytics software required to run multivariate regression analyses on these massive employee populations.
They have the tools to actually do the math.
Exactly. They identify the risk vectors, model the financial impact of remediating the pay gaps, and then manage the internal communication strategy.
It's a regulatory mandate generating highly lucrative, incredibly sticky consulting revenue. Once WTW integrates their compensation framework into a client's HRIS, they own that relationship. The benchmarking updates become recurring annual revenue.
Exactly. Moving to the wealth segment, which grew 5%, we see a different kind of growth vector capturing massive scale in retirement and pension management. The focal point here is LifeSite.
The LifeSite Master Trust Platform. Hess dropped a massive flex on the call regarding this. A Fortune 50 technology company appointed LifeSite to run its Master Trust pension program in the UK, adding £400 billion in assets under management from a single client.
£400 billion.
Unbelievable.
The scale of that asset capture from one discrete sales cycle is hard to overstate.
You don't win $400 billion in AUM just on price. What is the structural advantage of LifeSite?
It's a combination of their institutional investment proposition, leveraging WTW's massive global asset allocation capabilities, and a highly differentiated consumer-grade digital member experience.
Okay, so it appeals to both the company and the employee.
Right. Fortune 50 companies want institutional-grade risk management for their pension liabilities, but they want their employees to interact with an interface that feels like a modern fintech app.
Which brings us perfectly to the barbell strategy they are executing, because they didn't just highlight the massive Fortune 50 win, they also announced the acquisition of Cushion, a UK fintech pensions and savings provider. Why deploy capital to buy a fintech when you already dominate the enterprise space?
To aggressively capture the middle market. LifeSite is a heavyweight enterprise solution. The fast-growing mid-market defined contribution space in the UK requires a highly scalable, tech-led, lower-touch solution.
And that's Cushion.
Right. Cushion provides that proprietary technology layer. They are dominating the top of the market with bespoke enterprise consulting, and they are using Cushion's tech to vacuum up the volume in the mid-market. It is a textbook pincer movement to consolidate total market share in the UK pension space.
It's a brilliant allocation of capital, but, as analysts, we have to look for the structural weaknesses. The fourth pillar of HWC is benefits delivery and outsourcing, BD&O. It grew 5% in Q4, but the forward guidance management provided was jarring.
Yeah, that was a tough spot.
In a company projecting mid to high single digits across its portfolio, they guided BD&O to low single-digit growth for 2026. A low single-digit projection in a high-margin outsourcing business is a massive red flag. What is the headwind here?
Well, the headwind is entirely tied to the structural turbulence in the United States Medicare market.
Mark Hughes, an analyst on the call, specifically pressed them on this, trying to figure out if this was a transient 2026 issue or a multi-year structural drag.
And Julie Gebauer's explanation revealed a massive regulatory shift occurring in the background. The Centers for Medicare and Medicaid Services, CMS, has been aggressively tightening the reimbursement rates and risk adjustment models for Medicare Advantage plans.
Okay.
This is severely compressing the margins for the insurance carriers.
And when the carriers get squeezed by the government, they immediately pass that pressure down the distribution chain.
Precisely. They alter the commission structures for brokers, and they fundamentally change the economics of the group Medicare plans that large employers offer to their retirees.
So it trickles all the way down.
Yes. That volatility is causing a short-term contraction in WTW's individual commission revenues and causing clients to delay enrollment decisions.
So it's a legitimate structural drag on their current revenue model.
In the immediate term, absolutely.
Yeah.
But if we connect this to the bigger picture, management's thesis is that this regulatory squeeze will ultimately trigger a massive long-term windfall for WTW.
Walk me through that logic. How does a margin squeeze on Medicare Advantage turn into a WTW tailwind?
It comes down to corporate cost shedding. As the carriers raise the premiums on these group Medicare plans to protect their own margins, the large employers footing the bill will hit a breaking point.
Right, they can't afford it.
Exactly. They will determine that subsidizing a group retiree plan is no longer economically viable.
So they terminate the group plan, but they can't just abandon the retirees entirely, right?
No, exactly. They transition from defined benefit to defined contribution. They give the retiree a fixed stipend and push them into the individual Medicare marketplace to find their own coverage.
And WTW operates one of the largest private individual Medicare exchanges in the country.
They are essentially standing at the exit door of the group market. As employers inevitably fracture these massive group plans to save costs, millions of retirees will flow directly into WTW's individual marketplace, where WTW's licensed agents will guide them into individual Medicare Advantage or supplement plans, capturing the individual commissions. They are accepting a short-term growth deceleration now because they are structurally positioned to absorb a massive tidal wave of volume as the group market disintegrates over the next 5 years.
That is an incredibly long-term strategic view. It hurts the 2026 optics, but it solidifies the 2030 cash flow, which transitions us perfectly into management's broader playbook for the future. Looking backward at Q4 provides the foundation, but the equity valuation is entirely dependent on the future cash flows management is promising. Let's look at the guidance and capital allocation strategy for 2026.
CFO Andrew Krasner provided a highly defensible growth profile, mid-single-digit organic growth enterprise-wide, high single digits in health, mid to high in risk and broking, mid-single in career, and that low single-digit drag in BD&O.
The top-line growth is solid, but the absolute centerpiece of their forward guidance is the profitability commitment. Management is explicitly promising 100 basis points of average annual adjusted operating margin expansion over the next 2 years.
That's aggressive.
Committing to a full 1% of pure margin expansion on a multi-billion-dollar revenue base is a massive operational undertaking. How are they structurally engineering that?
They are executing an enterprise-wide operational efficiency program branded the We Do Initiative.
It sounds like a marketing slogan, but the mechanics behind it are aggressive. They specifically highlighted the deployment of agentic AI. Now, we already debated the Newfront AI acquisition, but this is a broader internal operational shift. I want to separate the reality from the hype. How does agentic AI actually differ from the generative AI tools every other company is playing with? And how does it guarantee 100 basis points of margin?
The distinction is critical here. Generative AI, like a standard large language model, is fundamentally reactive.
Right, a chatbot.
Exactly. A human prompts it and it generates text or code. It's a productivity assistant. Agentic AI is fundamentally autonomous. It is designed to execute multi-step workflows without human intervention.
Give me a tangible example of how that functions within WTW's back-end operations.
Imagine the claims processing or policy reconciliation workflow. An agentic AI system can autonomously monitor an incoming data stream, ingest an unstructured policy document, cross-reference it against the client's existing coverage database, identify discrepancy in the premium calculation, initiate a query to the carrier's API to resolve the discrepancy, and log the finalized data into the general ledger.
Without anyone touching it.
Right. It only escalates to a human broker if it encounters an unresolvable edge case.
So it's completely disintermediating the routine, high-volume administrative work.
Exactly. They're pairing this agentic AI architecture with their massive global delivery centers. It's an aggressive labor arbitrage and automation play.
Smart.
By migrating the routine administrative burden to autonomous systems and lower-cost delivery centers, the expensive onshore human capital, the senior brokers and consultants, can dedicate 100% of their bandwidth to high-margin advisory and complex risk structuring.
So the revenue scales linearly, but the headcount and administrative costs remain effectively flat.
Exactly. That operational leverage is what drives the 100 basis points of margin expansion.
If they successfully execute that margin expansion on top of their organic growth, the free cash flow generation is going to be staggering. We know they printed $1.5 billion last year. The pivotal question for any retail investor is, How is management going to allocate that capital? Do they empire build or do they return it to the shareholders?
Well, their stated capital allocation framework is highly disciplined and fundamentally shareholder-friendly. They committed to at least $1 billion in share repurchases in 2026.
Buying back $1 billion of their own float is a massive structural support for the equity. It artificially compresses the share count, driving up the EPS, even if net income stays perfectly flat.
Right.
But it's the signaling that matters just as much. Management is looking at the entire landscape of potential investments, bonds, internal R&D, massive acquisitions, and determining that buying their own stock is the highest yielding deployment of $1 billion.
It signals absolute confidence in their margin expansion trajectory. But they aren't totally eschewing external growth either. They're deploying capital into M&A, but doing so with surgical precision.
An analyst specifically challenged them on the call, asking why they weren't leaning harder into M&A over buybacks. Carl Hess was adamant that they are strictly targeting bolt-on acquisitions. We discussed Cushion in the UK pension market and Newfront in middle market broking. They also announced the acquisition of Flowstone Partners, slated to close in the first half of 2026.
Flowstone is a fascinating strategic asset. They specialize in the private equity secondary market.
Why does a massive insurance broker and HR consultant want to own a PE secondaries firm?
Because it aggressively expands the capabilities of their wealth segment. Institutional clients like pension funds, endowments, and high net worth individuals are increasingly demanding access to private market liquidity.
Okay, that makes sense.
The secondary PE market is highly complex and requires specialized valuation and structuring expertise. By bolting Flowstone into their existing wealth distribution network, WTW instantly offers a highly differentiated, high-margin alternative asset product to their existing client base.
So they aren't trying to buy a massive, bloated, multi-billion-dollar competitor just to inflate their top-line revenue and impress Wall Street.
Not at all.
They are identifying highly specific capabilities, AI, middle market quoting, UK tech-led pensions, PE secondaries, and bolting them into their global distribution engine. It's portfolio optimization, not empire building.
It demonstrates mature, disciplined capital allocation.
I agree, but there is one specific element of their capital allocation guidance that I want to aggressively challenge. Andrew Krasner explicitly stated that WTW will absorb a 30-cent EPS headwind in 2026, specifically to invest in the Willis Re joint venture.
Ah, yes, the Willis reinvestment.
A 30-cent drag on earnings. When you are publicly promising 100 basis points of margin expansion, voluntarily taking a massive hit to your EPS to build a new division seems entirely contradictory. The street inherently punishes EPS drag. Why is Carl Hess willing to take that beating on the bottom line right now?
This raises an important question about the classic tension between managing for the current quarter and architecting long-term strategic dominance. To understand why Hess is taking the hit, we have to deeply analyze the mechanics of the reinsurance market.
Let's break it down.
Reinsurance is the ultimate shock absorber for the global economy. It is insurance for insurance companies. When a primary carrier underwrites billions of dollars in highly concentrated, like a massive fleet of AI data centers or coastal property exposed to extreme weather events, they fundamentally cannot hold all of that liability on their own balance sheet.
The capital requirements would bankrupt them.
Exactly. So they go to the reinsurance market to cede a portion of that risk, either through proportional treaties or facultative reinsurance for specific assets.
They lay off the risk to the top of the food chain.
Exactly. Now, WTW is already one of the most dominant primary brokers in the world. They originate the risk, they structure the massive, complex programs for the underlying corporations, but historically, they haven't aggressively captured the economics at the very top of the risk stack.
Okay, I see where this is going.
By heavily capitalizing Willis Re, their commercial reinsurance joint venture, they're building the infrastructure to participate in the entire insurance value chain.
So they broker the initial complex placement for the Fortune 500 company, collect the fee, and then immediately turn around and participate in the highly lucrative reinsurance placement for the carrier that just took the risk.
Precisely. Think back to our discussion on the systemic risks of data centers or the massive Australian electrification grid. The aggregation of risk in those projects is so immense that they inherently demand massive reinsurance capacity.
Right, no single carrier can hold it.
By building Willis Re, WTW ensures they aren't just collecting a toll at the front door, they are monetizing the risk transfer all the way up into the capital markets.
But building a Tier 1 reinsurance broker requires immense upfront capital. You have to hire incredibly expensive, highly specialized reinsurance actuaries and catastrophe modelers, and you have to fund the operations through long, complex renewal cycles before the revenue actually hits the P&L.
Which is exactly what Kressner was referring to. That infrastructure build-out costs 30 cents per share in 2026. But look at the long-term payoff. The reinsurance market has hardened significantly, rates are elevated, and the demand for alternative capital and catastrophe bonds is surging.
So it's a long game.
5 years from now, Willis Re could be an absolute cash-generating machine, highly insulated from the standard macroeconomic cycles that dictate consumer spending. Hess is willingly sacrificing a fraction of today's EPS to build an impenetrable economic fortress for the 2030s.
I'll concede the point. When you frame it as capturing the top of the risk stack, a 30-cent investment is a cheap price for that level of vertical integration.
It's the hallmark of a management team that isn't terrified of short-term analyst downgrades.
So what does this all mean? We have waded through 13% adjusted EPS jumps, systemic infrastructure risks, 10% healthcare inflation, EU regulatory mandates, agentic AI, and reinsurance capital stacks. It is time for the definitive, actionable verdict for the retail investor. Let's build the bull and bear cases.
Let's start with the bull thesis. If you are deploying capital into WTW today, what is your core conviction based on this earnings call?
The bull thesis is anchored entirely in highly defensive, recurring revenue, combined with perfectly positioned offensive growth vectors. Regardless of whether the global economy is booming or entering a deep recession, multinational corporations fundamentally must insure their physical assets against catastrophe, they must protect their networks from cyber breaches, and they must manage their employees' healthcare and pension liabilities.
It's non-negotiable.
Exactly. WTW operates as a mandatory toll collector on the foundational plumbing of global business.
But it's more than just a defensive toll collector. They have perfectly aligned their specialty units directly in the path of unavoidable secular global megatrends.
Right. Their growth drivers are entirely decoupled from standard consumer discretionary spending. They are capturing the massive capital expenditures of the AI revolution through their dominant data center specialty. They are literally monetizing the crisis of 10% structural healthcare inflation by consulting desperate, self-funded employers.
And generating recurring, sticky revenue from the labyrinth of EU regulatory mandates like the Pay Transparency Directive.
These aren't transient economic fads. These are the deeply embedded structural realities of the global economy over the next decade.
And critically, they aren't allowing internal bloat to destroy that top-line growth. The We Do initiative, leveraging agentic AI and global delivery centers, provides a highly credible roadmap for 100 basis points of margin expansion. They are fundamentally rewiring their cost structure to ensure that a higher percentage of every dollar falls directly to the bottom line.
And as the final pillar of the bull case, they take the resulting $1.5 billion in free cash flow and deploy $1 billion of it directly into share repurchases, providing a massive floor for the equity, while executing highly targeted bolt-on M&A to capture high-margin niches like PE secondaries.
It's an incredibly robust defensive growth thesis. But, rigorous analysis requires us to interrogate the shadows of the 10K. What are the structural vulnerabilities? What breaks this thesis?
The most immediate threat is integration execution risk. They have aggressively acquired Newfront, Cushion, and are bringing on Flowstone. Management is heavily touting the AI synergies and the technological lift these acquisitions will provide.
Right.
But anyone who has lived through corporate M&A knows that integrating disparate proprietary technologies and clashing corporate cultures is a graveyard for shareholder value. If Newfront's core engineering talent rejects WTW's legacy IT architecture and walks out the door, the projected margin expansion from that AI integration instantly vaporizes into sunk costs.
A very real operational risk. Secondly, we have to examine the specific weakness explicitly noted in their own reporting. The Insurance Consulting and Technology segment, ICT, actually contracted by 1% in the fourth quarter.
In a quarter where everything else was compounding, a 1% contraction definitely stands out. Why did ICT shrink?
Andrew Kressner was very candid about it. He noted that clients remain highly cautious and hesitant to commit to large, multi-year technology implementation projects. It highlights a critical distinction. While corporations must buy insurance and manage healthcare, they can delay or cancel massive internal IT overhauls.
That's true.
If global corporate budgets continue to tighten, or if a recession forces CFOs to slash discretionary spending, that consulting weakness could easily metastasize from the ICT segment into their broader advisory units.
Which leads directly to the ultimate bear argument. Macro dependency. Yes, much of their revenue is defensive, but the high-flying 8% growth in corporate risk and broking was partially fueled by a resurgence in global M&A activity.
They monetize the transactional risk of those deals, exactly.
If central banks fail to navigate a soft landing, if credit markets freeze, or if geopolitical shocks cause global M&A activity to grind to an absolute halt, WTW's high-margin transactional liability broking and high-end strategic consulting will suffer a severe contraction. They are ultimately a derivative of corporate velocity.
So, weighing the robust defensive positioning against the realities of integration friction and macro dependency, what is your actionable verdict?
When I balance 12 consecutive quarters of high single-digit growth and complex corporate risk against the transient drag of Medicare Advantage restructuring, when I weigh the massive tailwind of 10% healthcare inflation against a minor 1% dip in discretionary tech consulting, WTW emerges as a uniquely powerful hybrid asset. It offers the defensive stability of a utility with the offensive growth optionality of a specialized consultancy. It is the ultimate picks and shovels play for corporate risk.
Very apt characterization.
During the gold rush, the most consistent returns weren't made by the prospectors betting on a single mine. They were made by the merchants selling the shovels to everyone digging. Today, the global economy is desperately digging through an avalanche of cyber threats, AI infrastructure demands, supply chain fracturing, and regulatory chaos. WTW is selling the highly specialized shovels, the structural hard hats, and the complex builder's risk insurance policies for the mine itself. As long as the global operating environment remains volatile and highly complex, WTW's ability to compound its free cash flow seems exceptionally secure.
An incredibly sound, data-driven verdict. And as we conclude this analysis, I want to leave the listener with a final, slightly philosophical reflection to consider.
Bring it home.
If you look past the adjusted EPS, the margin expansion targets, and the free cash flow yields, if you truly read between the lines of WTW's earnings call, you aren't just analyzing a corporate ledger. You are staring into a mirror, reflecting the deepest, most pervasive anxieties of the modern global economy.
Wow, yeah.
Consider what is actually driving this multi-billion-dollar entity to record profitability. Their primary growth vectors are soaring, uncontrollable healthcare inflation that threatens to break corporate balance sheets, terrifying systemic cyber and environmental threats that could trigger cascading global liability.
That's all the scary stuff.
Exactly. Byzantine, highly punitive workplace regulations that internal HR departments simply cannot decipher, and the frantic, almost reckless infrastructure rollout required to support an artificial intelligence revolution that society doesn't fully understand.
That's a lot of fear.
As long as our world remains hyper-complex, deeply volatile, and fundamentally anxious, companies like WTW will not merely survive, they will dominate. They've constructed an impregnable economic fortress on the very foundation of corporate fear.
That's powerful.
So, as you evaluate your portfolio allocations, the ultimate question you must reconcile is this. What does it say about the underlying structure of our modern economy that a multinational corporation's absolute best, most profitable quarter is fueled by the exact same chaotic forces that are keeping every other CEO awake at night? Are you investing in a solution, or are you simply monetizing the anxiety?
That is the defining quotient of modern capital allocation. Thank you for joining us on this exhaustive journey through the hard data, the structural panics, and the murky, highly profitable waters of global risk management. We hope we brought some clarity to the diagnostic picture today. Keep digging into the fundamentals, keep challenging the corporate narratives, and we will see you right back here for the next deep dive.